Welcome to Stuff Happens. Mind the gap. It's a warning and it's often given to commuters, but our warning to investors right here is mind the right gap. This first chart right here shows the gap that investors were looking at um, in the outperformance of the Mag 7 versus the rest of the S&P 500. The S&P 500, that gap existed for most of 2025 and into 2026, only dissipating when investors start to become concerned about the significant amount of dollars are being spent on the AI buildup. The next gap that investors were looking at was the gap between the outperformance of the SOX index, the Philadelphia Semiconductor Index, and the rest of the S&P 500. This gap opened up at the end of March as those concerns about the build out quickly led investors to believe that a safer bet on the build out of AI was in the chip sector. So this gap uh, quickly grew and it still persists to this day. But this is a gap that we think investors should be paying attention to. This is a chart that shows the CAPEX spent by tech versus the CAPEX annual percentage change spent by non-tech. And as you can see, that gap is significant. And it's significant, it's important for investors to look at this to understand that outsized returns are generated by looking at those parts of the capital market where capital is scarce, not where it's overabundant. And investors have not been minding this gap, and in fact, as this gap continues to persist and capital continues to flow into the tech sector, despite returns that are indeterminate and suspect at best. And we're currently seeing evidence of this persistent spending gap in the aftermath of the Iranian and U.S. conflict. Prior to conflict, there was about $45 billion that were spent annually in CapEx spent annually by the global refining industry. And with the onset of the shutdown of the Strait of Hormuz, those barrels of refined product were shut in, um, quickly became a problem for those customers that were waiting for refined product, mostly customers in Southeast Asia and parts of Europe. And we saw this become a problem, an issue quickly in the jet fuel market, but that also quickly spread into the diesel market as well. And the global oil industry, despite the shutdown, did a remarkable job of making sure that those displaced barrels were replaced. And while there were some spot shortages, the system was able to quickly rebalance itself. But the system, but it's important to understand that the situation is not entirely over yet, and the strait remains closed, and a good quantity of those barrels remain shut in. And the point is that the critical part of the global energy industry has received very little CapEx over the last 5 years, 5 to 7 years, despite being such a highly integral part of the energy supply chain. Because of this lack, because of this lack of any redundancy and slack in the system, margins or crack spreads in the vernacular have exploded and they remain at multi-decade highs. So this gap, as evidenced by this chart right here, shows the performance of Valero Energy, which is the largest U.S. independent oil refiner, versus the performance of NVIDIA. So our point to investors is, if you mind the gap, but mind the right gap. So thanks for listening, and we look forward to talking to you next week.